So now that we are familiar with the main source of data that are included in financial accounting, we can now describe a little more in detail which are the main processes that characterize the financial accounting software and module in SAP. In particular, this is what we were trying to clarify. So how to posting on the general ledger accounting, how to posting on account receivable accounting and account payable accounting, and then we'll see some principle about asset recording and accounting, and some reporting in SAP about financial activities. So, as already explained, in SAP you have 4 types of processes that you need to manage from an accounting perspective, and that we'll see all of them in the course, which is general ledger accounting, which means how to record all the transactions that impact business processes outside those that involve vendor and customer, because all that involve vendor and customer are included in accounts receivable accounting, so using the reconciliation account and the subledger related to the customer. Accounts payable accounting, which instead involve the reconciliation account and the subledger account that refers to the vendor. Then we have asset accounting, which instead involve everything which is related to recording and let's say posting activities about asset management. While instead the last one, it's not something that we will analyze, which is bank ledger. So posting cash, how cash is taken in and out from the bank account, so recording of bank transaction. We'll start from general ledger accounting, and as I explained in the last class, general ledger accounting include all the posting that have been made in a specific period of time, generally a year, on all the accounts that are included in the chart of account and are part of the general ledger account. So here you see the exact example of what we saw in the last class, let's say from a more theoretical perspective. So this is how all the posting in the general ledger are visualized in SAP. And this transaction, which again summarize the posting of transaction in a specific period of time, can refer to balance sheets account if they refer to asset or liabilities, or income if they refer to profit revenue, cost transaction, which have been included in the general ledger. In particular, to understand how posting in the general ledger works, you need to remember something that we already anticipated in the previous class, which is referred to the double bookkeeping principle and the T account recording of transaction. So transaction in the general ledger, but in a following any accounting rule, is made through T account. T account is, as you can see here, a T representation which record on the left debit posting and on the right credit posting. As you can see here, and you can see reported in the slide, if you are talking about an asset account, an increase in an asset account or an expense account will result in a debit posting. So wherever you are increasing the value of your asset or you are incurring in a cost, you are posting this on the left side of your T account. While instead, if it is an increase, whenever it is a decrease, so if you are recording a decrease in asset or you are recovering from a cost, you are posting is as a credit, so you are using the right side of the T account. Instead, if you're talking about a revenue account as opposed to cost, or a liability account as opposed to asset, like this exactly reversed. So whenever you increase, you have revenue, a positive revenue, or you increase your liability, you are posting this as a credit. So the plus for revenue and liabilities is on the credit side, while instead, if they decrease, they generate a debit posting. How does it work from a practical perspective? Let's see this as an example. So we have here in this example where we say a venture capitalist invest $50,000 in to buy 50,000 stocks of GBI US, and they do that on January 10, 2017. Which are the effects of this transaction? On one side, JBI deposits this liquidity into its bank account. So this generates a cash in for JBI in the bank account. In exchange, the investor receives, let's say, in the shareholder equity, they receive a value of $1 per share, so $50,000. What does it mean from a T account perspective? So you are increasing an asset, bank account, debit posting, and you are increasing a liabilities, common stock, equity, credit posting. And again, as you can see, for the principle, the accounting equation, asset equal liability, you are increasing an asset, you are still increasing liability, so it means that the value of the asset is still matching the value of the liability. Second example, let's hypothesize instead that JBI decide to purchase office supplies for $500 using check, so paying out of the pocket. What does it mean from a T account perspective? So on one side, you are decreasing your bank account because you are paying the supplies out of the pocket. So this results in an asset decrease, which is a credit posting. On the other side, you are increasing an expense, so a cost, which is a debit posting. So if the expenses increase, this is a debit posting. Let's see a same example in a different mode. JBI decided to purchase office supplies for $1,000 but on credit. First effect, you are increasing the expense for office supply, for supply expense of $1,000, debit posting. Then remember that you are not paying that out of the pocket, but you are paying them on credit, which means that your account payable, which are liabilities, are increased of the same amount, $1,000. Then, of course, hopefully it will arrive a period of time in which you will have to pay the supplier. When this time will arrive, what will happen is that when it's time to pay, your bank account will be decreased of $1,000 because you have to pay the supplier. Credit posting, and your account payable will be decreased as well of the amount that you were owing to the supplier, $1,000, debit posting. That's how the T account works. How can you post in SAP this type of movement? You can see here from the menu. So here you have to reach accounting, because again we are under the accounting module, financial accounting, general ledger, posting, and here you see the different possibility to post the transaction that you want to record in the general ledger. Here you see an example. So in this case, we are posting a debit into a bank account of $5,000 and a credit of the same amount for common stock. So we are recording the previous transaction. In particular, and you can see it here. So you see one is credit, which is the increase in common stock, and it is indicated here. You see, you are posting a credit for liabilities of $5,000, and you are posting a debit for a decrease in asset of the same amount. If everything is posted correctly for SAP, is provided by this screen. You see that the green light indicates that you are doing it correctly. So SAP is giving you feedback if you are posting let's say the transaction correctly, respecting the accounting principle. If it is red, it means that you cannot proceed without fixing the mistake. If it is yellow, it means that it's not perfect, but it's still acceptable, but it means that you are keeping an error that at a certain point you will have to solve. Now, if once you have recorded a transaction in SAP, of course, you can claim document summarizing the characteristic of the transaction. So the effect, to summarize the effect of the transaction that you just recorded. This can be done by opening the general ledger account, display balances, and as you can see, if you display the balance, now both the bank account and the common stock account are updated with the decrease in $50,000, the increase in $50,000, the decrease in $50,000, the increase in $50,000 of the asset, and the increase of $50,000 in common stock. So thanks to this, you can verify that once you have posted a transaction, this has been well received and this has been well reflected by the new balance. Of course, whenever you post a transaction, okay, remember that as when you manage a procurement process or a sales and distribution process, you generate a purchase order or sales order or delivery document. Every time you post a transaction, you record an event in the general ledger, this generates an associated document, and that's what you see here. So if you call out document display, okay, so accounting, general ledger, document, display, you can call out on a certain period all the documents that have been generated for the general ledger in the period that you are considering. The last one generated is, of course, the one that we have generated after our transaction. And if we select this document, we can see exactly a summary of what we have done. So we have increased the bank account of $5,000, and we have increased as well the common stock account of $5,000 as an effect of this transaction. So this type of posting is made for all the, let's say, account of revenue, expenses, and whatever that are not referring to vendor and customer. Because if you are referring to vendor or customer, as we already discussed, we are not using the general ledger, but we are using what they are called the sub-ledger and the reconciliation account that are going to modify the amount of account receivable with customer and account payable with supplier that the company is actually having for the period that we are considering for our financial accounting activities. Let's start with accounts payable accounting, so the one concerned with vendor. So basically, as we discussed when we were talking about the different type of ledger, like companies are very sensitive about activities with customer and supplier. So they don't want these activities to be mixed and to be not at the attention when they are like confused and mixed with all the other accounts. So they create a separate part in the general ledger, which are called like sub-ledger, where they just like record transactions which are related to vendor and customer. Why? Because again, for customer, for vendor, they want to track the money that they owe to the vendor separately, because again, they affect their liquidity and also their economic and financial performance. So they create sub-ledgers. Okay, you see, they create sub-ledgers, which are of course linked to the vendor master data. So each vendor has its sub-ledger where all the transactions related to the economic activities with the vendor are posted. Then these sub-ledger are maintained and reconciliated through the accounts payable reconciliated account, which then, let's say, is the point of connection with the general ledger. So once all the transaction in the sub-ledger for the vendor are consolidated through the reconciliation account, then the sum of this activity is posted in the general ledger, but is only through the subledger that the company can analyze and can recover the specificity of the transaction made by single vendors. Let's see how it works. It's a little bit technical, but again, this helps in understanding how SAP works, because if you will ever ask, imagine you work in procurement and you have to record a transaction of this type, you have to be able to understand how this transaction works to record it appropriately. Same if you work in sales and distribution. Like, you have to know how it works with subledger and reconciliation account to post it appropriately, or to tell your people in finance and accounting how to post this transaction appropriately. So let's see this case. So GBI purchased office supply from 3 vendors. Okay, each vendor has a designated vendor account number. So each vendor has a master data, it has an associated master data and an account number. This account number is also the number to which the subledger of the vendor is associated to. Okay, so we have a master data where the account number of the vendor is associated, and the same account number is also used for the subledger linked to this vendor. So the transactions are as following. We purchase $2,000 from vendor 1. We purchase $1,000 from vendor 2 and $4,000 from vendor 3. These payments are made not out of the pocket, but are made on credit. So today I receive the goods, but I will pay them tomorrow. So we need to use in some way the accounts payable, because for a certain amount of time I need to record in my balance sheet and economic activities that I have received something from the vendor, so they have provided me supply, but I haven't paid them yet. So the financial transaction, the cash out, has not been received yet by the vendor. Let's see how to record these purchases on credit from each vendor. So this is divided into two at two levels. So at first level, each vendor has a sub-ledger account. So vendor 1, vendor 2, and vendor 3. You see here, vendor 1, vendor 2, and vendor 3. Each one has a sub-ledger account which is connected to the accounts payable. So of course I use the sub-ledger account only when I'm paying on credit. Like if I would pay it on cash, like this step wouldn't be present. So the account payable sub-ledger account for each vendor is increased. So a credit posting of $2,000, $1,000, and $4,000. Then in the subledger, we keep separated the 3 transactions. Then when you post this on the subledger, on the general ledger, there is an account which is called Account Payable Reconciliation Account, where these 3 transactions are consolidated into one. So the Accounts Payable Reconciliation Account of the general ledger just see the total number. So 2 plus 1 plus 4, $7,000, posted as account payable. So if I want to access the specific amount of money that I owe to each vendor, I need to pass through the subledger. The subledger then are consolidated into the general ledger through the Account Payable Reconciliation Account. As I am increasing a liabilities account payable credit, I have to counterbalance that in order to respect like the accounting double bookkeeping. In particular, what I'm touching is that I'm increasing of the same amount, $7,000, the supplier expense cost item. The number that you see here are the account, the fake account that are associated in SAP to each, the account number that are associated in SAP to each account. Again, the details are not kept at general ledger level. Then, now I have credit, okay? When it will be time to pay the supplier, that's what happened. So now I hope that you understand also, that you remember also from the previous example. So that's what happened. So each account payable subledger account connected to each vendor is decreased of $2,000, $1,000, and $4,000 because this is the amount of money that I'm not paying to my supplier. So I don't have any more accounts payable. When I do that, in the correspondent account payable reconciliation account, a decrease of $7,000 is posted to consolidate the transaction posted in the subledger account. To balance this decrease in liabilities, debit posting, I have a decrease in an asset, credit posting, bank account. In SAP, if you want to review reconciliation and non-reconciliation account payable in SAP, you have to, of course, call out the number of the account you are looking for. In this case, we have payables trade account, and payables miscellaneous here. If you open the tab Control Data, you can see that one of these is, let's say, classified as a reconciliation account. So this is where transactions are posted in reaction to what has been posted in subledger of vendor, while instead here we are talking about miscellaneous, and miscellaneous are posted directly in the general ledger account, included in the general ledger. And in fact, you see that the payables for miscellaneous stuff are classified as a balance sheet account. That's for what concerns the vendor. For the customer, that's exactly the same. So instead of having account payable posting, you will have accounts receivable posting. So the idea is still the same. So company wants to track money that customer owe to the company separately, and each customer which is relevant for the company is associated a number in the master data, which is the same number of the subledger associated to this customer. So transactions related to the customer are recorded in a customer subledger account, and this posting in the customer subledger account is then transferred to the general ledger through the account receivable or reconciliation account. Example, GBI sells bicycle to 2 different customers on credit, so they don't pay out of the pocket, same as you did before. So you're not paying your supplier out of the pocket, you are paying it after some times. Here, your customer are not paying you right now, they are paying you after some time. So the customer, so you generate account receivable, so you are waiting to receive money from the customer for these 2 different sales. How much is the amount of sales? $5,000 to customer 1 and $3,000 for customer 2. Again, GBI makes the sales on debit and then get payment from the customer at a later date via check. How this translates into the accounts payable accounting principle in SAP. So you have customer 1 and customer 2, each one having their subledger account. So I'm posting a debit, so I'm increasing, remember, I'm increasing debit posting, the asset of accounts payable, accounts receivable for $5,000 for customer 1 and $3,000 for customer 2. This transaction is consolidated into the account receivable reconciliation account, $5,000 and $3,000 in the general ledger. As these need to be balanced in some way for respecting the double entry posting of the accounting in the as accounting principle. We have also to increase in this case, while in the previous case we were increasing the cost, debit posting. In this case we are increasing the revenues because remember we are working on the accrual basis accounting, so it doesn't matter if this transaction hasn't generated financial effect yet. We are interested in recording economic effect, so everything that is sold is in the end of the customer. the customer is owning this product, so for us it's a sales, even if we don't have the money yet, so the physical money yet. So we are increasing the sales credit posting of $8,000. Then, when the customer is going to pay me, we need to record the payment from each customer. So again, that's the point of start. We are decreasing the sub-ledger account receivable of the customer of the amount they are paying us, $5,000 and $3,000. This gives us an increase of our bank account of this amount, so we are posting an increase, so they are going to pay us $8,000, which are our cash, so we increase our bank account, and we reconcile this transaction in the account receivable reconciliation account in the general ledger, which is decreased credit posting of $8,000. Now, the last type of process that we're going to analyze is asset accounting. So how to record asset transaction, asset modification into SAP. So asset accounting concern with tracking the financial consequences associated to owing an asset as a life cycle during time, of course, decrease, and this decrease, of course, also the cost and the impact that this asset has on our balance sheet on the asset side, but also on our income statement through depreciation or amortization according to the nature of the asset. In particular, asset accounting is concerned with three different type of aspects that we are going to analyze a little bit. First is the concept of ownership. So each asset is owned by a company to support process, so it needs to be assigned to a company code. So an asset is owned by one or more company code and or a business area. So supports processes of a company and or a business area. Then every transaction of an asset that concerns an asset, similar as customer and vendor, is posted in subledger account. The effect of this transaction are then reconciliated through reconciliation account in the general ledger. So besides the fact that we're talking about asset and not customer and not vendor, the principles are the same. Asset in SAP can be classified in different classes. For example, here you see some options. So you have land, you have production, you have machinery, equipment, you have vehicles, office equipment and computers. So first, asset belong to a class. So an asset class is a grouping of assets that possess a similar characteristic. Again, all computer equipment, such as computer like printers, monitor, can be included in an asset class, and from an SAP perspective, they are treated in the same way, which means that each asset class will be associated to a specific reconciliation account in the general ledger and will have a separate posting in a subledger account. The reconciliation account for each asset in the asset subledger account is determined by its association with an asset class, and that's exactly what this figure try to tell you. In particular, this figure shows 3 of the 5 reconciliation accounts that are included in the GBI general ledger, and 4 type of asset classes: office furniture, office equipment, office computer, and vehicle. looked at the fact that in particular office equipment and office computer, being very similar to each other from an SAP perspective, are associated to the same reconciliation account, and so again they will have different sub-ledger posting but then the same reconciliation account in the general ledger. But basically for each asset class or group of asset class, like in this case, SAP maintain a reconciliation account in the general ledger, and whenever something is posted in a sub-ledger account for each asset class, these are then consolidated in the corresponding reconciliation account in the general ledger. It's the same as vendor. It's nothing different with vendor and customer. In this case, you just have to separate different class of assets, so you have multiple reconciliation account, while you don't separate different class of vendor or different class of customer. It's the same, you just have more than one reconciliation account included in the general ledger. If you want to see let's say the asset classes and the asset account in SAP, you have to call under accounting fixed asset and call the transaction AS03 asset, and when you will call out the different chart of account concerned by the company that you are looking for, in our case GL00, here you see in our case this is the type of assets that are referred to GBI. We have land, production machinery, accumulated depreciation for production machinery, office furniture, vehicles, intangible asset. All of these are the assets which are included in asset accounting. And if you click on that, like in this case, if you click on office equipment and computer, then you can visualize the characteristic of the asset and the master data associated to the asset. There is an either section when they are telling you the account number, the class number, and then the different information. For example, last time this asset was capitalized, when was first acquired, how much is the depreciation and amortization that you have to do each year, and so on. Concerned to this, remember that in SAP you need to mandatory record three types of transaction: acquisition, depreciation, and retirement. So acquisition is concerned to the fact that you are buying a new asset via an internal or an external process. So you can produce your asset yourself. Imagine you are buying a new machinery and your production department is making this machinery. This is easy because it's internally managed, and we're not treating this case because it is managed through the purchase order, and we will see when we will deal with the production module how does it mean. Instead, it's much more interesting if when we are purchasing a new asset externally, so from a vendor. In particular, there are three options that you can use. One is purchase from an established vendor without using the purchasing process. So the asset is made not through a structured purchasing process, but using a manual entry in the general ledger and sub-ledger for the asset, similar to what we saw to accounts payable. So again, when we deal with accounts payable and account receivable, we haven't, let's say, used actually the sales and distribution process and the procurement process, but we have just posted this transaction directly into the sub-ledger and the reconciliation account. This is the same case. So you are purchasing an asset and you are manually entry in the general ledger and the sub-ledger of the asset, the account of the asset, this transaction. Or you can purchase from an established vendor using the purchasing process, so using different general ledger account, and we will see that when we'll deal with when we'll deal with the purchasing process. The last option is to purchase these from a one-time vendor. Okay, so a vendor that is not supposed to be vendor anymore for the company, or a vendor from whom a master data are not already included and probably won't be anymore. This is done through clearing account. Clearing account are temporary accounts that are created to manage transactions that are not supposed to be repeated in the future. Let's see the example of the acquisition from an external vendor, and in particular an acquisition of an asset from a one-time vendor, which is the most interesting cases because the first case is all similar to what we saw with customer and vendor in accounts receivable and accounts payable accounting. The second one will be much clearer when we will deal with the purchasing process. This one instead is particular, and it's also the one that is most used because people just post transaction temporarily, no matter what, using clearing accounts. So, case, let's make the hypothesis that we are acquiring an asset from a one-time vendor. So we are purchasing a new desktop computer from a vendor for $5,000, and the payment needs to be made at a later date. So you need to create the asset master data from the new computer, so the desktop computer number 14, and instead you don't have to deal with the vendor because this vendor is one time, and so you don't have any master data and any other account already associated to this, but you will use a clearing account. That's what happened. So first, when the purchasing is completed, you will post in the subledger associated to office computer furniture an increase in asset of 5,000. Okay, then this transaction will be consolidated and reconciliated immediately in the general ledger account, office equipment and computers in the general ledger. So again, in this case, we are just buying one computer, so we are just using one time a subledger. This is just one ratio posted on the reconciliation account. However, as you can see here, we have an asset acquisition clearing account, which is created to take track of the fact that we are buying this from a one-time vendor, which is first credited of $5,000 $5,000 because it's taking in consideration that we have a debit for the asset acquisition of $5,000. But then it was cleared. It was cleared when the invoice will be received at a later step, which is here. When the invoice is received, okay. When the invoice is received, the clearing account will be cleared. You see, we are decreasing the debit posting of $5,000, and this will be passed. So this debit will be passed to the account payable. Sorry, this was of course like a mistake. This need to be hidden. Okay, so this is actually was not supposed to be displayed. So the point is that you are posting. You increase an asset which is reconciliated in the office equipment and computer general ledger reconciliation account. This generates a credit posting in the asset acquisition to, let's say, maintain the fact that you have a debit currently, you owe money currently to a supplier which is not in your system. When the invoice will be received, this case, you can clear this temporary account of $5,000, and this debit will be passed to the accounts payable account in the general ledger. Then, when it will be time to pay the supplier, the accounts payable will be decreased of the amount of the debit that you owe to the supplier, and this posting will be balanced by a decrease of $5,000 in the bank account. If you want to acquire an asset in SAP through this procedure, this is what you have to do. Again, we will see more in detail in class through simulation, but this is what you have to do. So, accounting, financial accounting, acquisition, external acquisition with vendor. F90 is telling you acquire an asset from a vendor which is not maintained in the system. And then, of course, you have to enter all the information manually to record the transaction of with the one-time vendor, and be sure that it's posted correctly in the account, in the subledger, and in the general ledger. However, the most important part is not related to the acquisition, but is related to the depreciation. Again, this is not an accounting course. I already explained what is a depreciation, but remember that it is an important part of SAP, because SAP allowed to do a depreciation of asset manually, automated, instead of being this necessary to be done manually. So remember, the asset have a life cycle. When you buy an asset, not all the cost is included in the income statement at the first year, but the cost is split along the life cycle for which we think the asset will contribute to the company operation. So every year we have to run a depreciation. So we have included in the system how much is the life cycle of the asset, and how much every year we want to depreciate the asset. So every year we have to run a depreciation cycle to decrease the value of the asset and associate this depreciation to the income statement as a cost item for all the assets that we own. Again, of course, I'm talking about ordinary depreciation. Of course, remember that there can be unplanned depreciation. So imagine a machinery that got ruined, and so you have 5 years left, but the machine is no more running, so you have to depreciate all this value in this year because it will be no more usable the next one. And it can happen as a straight line, so by decreasing constantly the same quantity every year, or double declining, applying a percentage to the residual values. I already talked about that in the previous class. If it's not clear, please review it because it's a key concept. Okay? This can be done automatically, calling out the transaction in SAP, which is called depreciation run, which you can find here. It's called AFAB. It's very popular, and in the company usually very few people has authority and access to this type of transaction. When you call out this FAB, I mean, we will see this in class, but what you usually do for the selecting period, fiscal year 2010, posting period 7, you are telling SAP with the parameter to execute in background depreciation of the assets that are included in the company balance sheet at a particular point of time. The last one, we are not dealing with that, is retirement. So when you have to dispose or retire an asset, usually this is managed. So the value of the asset is posed to 0, and according if it is done with or without a revenue associated, you will manage this through the sales and distribution process, so the fulfillment process. We will see the dynamics of this when we will deal with the sales and distribution process. Finally, to conclude, we can see some reporting that you can generate using the financial accounting module of SAP. First of all, why reporting? Because, I mean, as you can imagine, financial accounting is the most important process in the company. Why? Because it's the only process which is integrated with all the other processes in the company. So procurement, production, fulfillment, management accounting, project management, inventory and warehouse management, they all execute activities. We have a financial impact. So the financial accounting process needs to be connected and linked to all these other processes. For this reason, different type of reporting are needed and need to be provided, and which can be called out by different process in a company. In particular, there are three type of reporting which are particularly relevant for us. So display information about the account in the chart of account, display information about the asset, and the generation of the financial statement. Whenever you call out the reporting, for example, for an account, you can visualize or the balance. So today, the bank account has tot dollar like included as a balance. Line item, or we have this balance because during this period this happened, or even more in detail, calling out the original financial document. So seeing exactly what each line item refers to by calling out the transaction document that was created when this transaction was posted. Example, you call the function general ledger account balance display. In this case, you are calling out the account number 10000, which is our well-known bank account. Here you can see the balance. You see balance. You see how much you have at the end, the total of debit, the total of credit, and the total of balance. And in particular, you can then see exactly how this balance was determined through the different line item. If you click on each line item, you can call out the document that is associated with the transaction that was recorded in this account included in the general ledger. Asset Explorer instead is concerned to seeing data about all the activities related to asset accounting, acquisition, depreciation, master data, transaction document created, and whatever. How can you do that? By calling out the transaction AW01N Asset Explorer, and that is usually what you display. In particular, what is relevant are here the information about the depreciation of the asset. In particular, we have this asset, which is office computer, acquired, we are in the fiscal year 2010, and you can see here that the let's say the acquisition value was $20,000, and we are applying this year an ordinary depreciation of $1,500. So this year we are depreciating this office computer asset class value of $1,500. And in particular, these are referred to these probably two different types of depreciation, which are listed here. So the 15th of July, you are posting two different depreciation, two particular assets which are included in this asset class, each one of $750. So in total, you are running a depreciation of $50,000. Finally, and we have already saw that in class yesterday, you can generate a financial statement, which is also the most important part of the SAP financial accounting module. In particular, you can generate, we have seen how to generate balance sheet, income statement, and statement of cash flow. We can have different visualization. We have seen in class, so we have different type of reporting option, comparison between years, different type of organizational level, but what you obtain is no other than a visualization of the asset, liabilities, costs, and revenues of the companies for the period that you are interested in. In particular, you call out the transaction general ledger report, and then according to what you need, financial statement, cash flow, and that's what you visualize. In this case, you are visualizing the reporting period of 2010 compared to 2009, and you visualize, you see asset, liabilities, and equity, and profit and loss statement, which can be exploded using this arrow in the different line items.